Now here's a graph to take the breath away. It's the Swiss franc versus the euro. In September 2011, it was pegged at 1.2 to the euro, or 83 euro cents to the franc. Last night, the Swiss central bank stunned the markets by abandoning the peg and cutting the official interest rate from minus 0.25% to minus 0.75%. That's right, minus. You have to pay them to look after your money. And the Swiss franc immediately showed what pressure the bank had been under by jumping straight to parity with the euro. And the Swiss stock market crashed 8.7% at the same time. Exports, mainly watches and chocolate, just got more expensive. So did the hotels for tourists. In general, Swiss industry is in big trouble. But the central bank obviously just couldn't hold the peg anymore because the euro is sliding. In the past 8 months, the euro has fallen 15% against the US dollar. Well, it did that last night against the Swiss franc in about 8 minutes. European markets went up last night while Wall Street fell again. So did the Tokyo market, and Shanghai went up. Now, you know how there's an index of volatility. Well, would you believe there's also an index of the volatility index? And no, this is not a Monty Python sketch. This is the financial markets, which is sometimes the same thing. Anyway, the volatility of volatility is rising. Where will it end? Gold jumped $30 or 2.2% to a 5-month high. Copper bottomed and went up a bit. Oil and wheat fell, but iron ore also went up. The local share market has now fallen every day this week, although today there was a big rise by the gold miner Newcrest for obvious reasons. Energy and financial stocks fell and retailers went up, and the Australian dollar jumped back above 82 US cents amid all that turmoil on foreign exchange markets. And that's finance.